Welcome to the Startup Club podcast, where we share the journeys of innovation, failure, resilience, and triumph of some of South Africa's most exciting tech startup founders and investors. I'm Matthew Marsden, founder of Startup Club ZA, and on the show today, Paul Kent, founder and CEO of Adumo, the omni-channel payments platform and software business committed to streamlining transactions, boosting customer engagement, and incentivizing businesses' employees. By 2024, Adumo had grown to serve more than 23,000 active merchants and is processing more than 100 billion rand in annual throughput. In May of this year, the business was consequently acquired by JSE-listed fintech group Lesaka Technologies in a 1.6 billion rand cash and equity deal that's recently just received go-ahead from the country's Competition Commission. Now, with more than 2 decades of startup experience behind him, and having navigated the many highs and lows of the founder journey, Paul and the Adumo team are ready and more excited than ever for the next leg of the journey. Now, before we get into today's discussion, Startup Club ZA is built on impactful partnerships, and today's episode is brought to you in collaboration with our friends at Guardrisk Launchpad. Now, Guardrisk, part of the broader Momentum Group, is the leader in South African cell-captive insurance, fundamentally enabling other businesses to access the conventional insurance market. And to drive insurtech innovation, Guardrisk created Launchpad, a pioneering initiative to support qualifying ventures and enabling them to launch new digital insurance products both fast and seamlessly. We sat down with Guardrisk Managing Executive Olani Nhlanga to discuss more about the initiative, and you can hear that conversation at the halfway mark of today's episode, or visit grlaunchpad.com to learn more. For now though, let's get back to today's discussion.
And if I look back, and the one regret that I have is we could have scaled quicker, we could have scaled larger in those early years because we were the first mover. And partly that is coming out of a business mindset where 100, 150, 300% growth, which is what we had in those early years, looked incredible. But looking back, it could have been more. I've been through, I guess, every part up until now of a business life cycle, from founding or starting a business through to listing or through to merging into a listed entity. So it's been quite fascinating. And in between that, we've done fundraising, we've done M&A, we've consolidated our operations, we've closed some businesses. So I've been through a lot in this period of time. But the one thing that I've always been committed to and excited about is the business opportunity.
Fintech has long been the darling of the African startup and venture capital ecosystem. But below the surface of this complex category, payments and the ability to transact easily has really been at the forefront of innovation. Now, South Africa's payments landscape is both diverse and dynamic, with a mix of traditional banking systems, mobile payments platforms, challenger POS brands, and a growing appetite for novel fintech solutions. Compared to developed markets, adoption has been comparably slow because of gaps in digital infrastructure, bank monopolies, high transaction fees, and simply access to data, hindering progress towards financial inclusion. And yet, the last 2 decades have seen radical transformation in our payment space, taking us out of the predominantly cash-based and manual dark ages and bringing consumers and businesses into the digital age and light, with a choice of more than 18 recognized payment systems that are regulated by the Reserve Bank. Today's guest, Paul Kent, has witnessed this payments evolution firsthand, having grown one of the country's first non-bank card payments businesses. And after nearly 2 decades growing various payment startups, he knows that the opportunity is greater than ever.
Yeah, I mean, it does. It feels like yesterday that we started, but fast forward 16 years, I think it is. So it's gone with the blink of an eye. I think if we go back, or we go further back to, I guess, childhood, and, I think whether they're born or whether they're made, I think, whatever happens is what's the influence you have when you're growing up? What access do you have to people, to knowledge, to role models in particular? And I traveled when I was young, and when I mean traveled, I was born in the UK, moved to South Africa in the early 80s. And I think that shock of moving is quite traumatic on young kids. I've got a 8 and 11-year-old now, and I think, geez, taking them, moving them to another country in today's world is hard enough. But looking back in those early days when, my parents moved on, they received a flyer when they were walking around their closest city. We'd never been to the country. They took the risk and packed us on an aeroplane and moved us to South Africa. So I think that does build resilience. I think it creates a personality. Those traumatic experiences break some people, but sometimes they make people. And I do think that I talk about resilience, or the ability to change and to manage change, is something that is needed for an entrepreneur. And I think that was a big element of helping me manage change that came out of that experience. And then I've had great role models. In the UK, my grandfather, an entrepreneur. I think back in those days, very different type of entrepreneur from what we see now. But he post the war in the UK, he started a business selling fruit and vegetables and flowers with his cart and horse, going around the village. That went from that as a start into owning a business, into owning a shop. At one stage, he had 3 stores, and for me, was I looked up to him. He provided great guidance. He was a super role model. I get very fond memories thinking about my grandfather.
Sure. And thanks for sharing that. You'd mentioned to me previously your dad was an electrician by trade, had done some work in the mines in the UK. I find it fascinating that again, it could just be a sign of the times perhaps, that he's moved his family to a country he's never been to on a whim, having received a flyer, and yet at the same time, that's maybe how things were done back then. No digital comms, if you would, and no research ahead of the time, unless you knew people, perhaps. The question I have for you is, your grandfather was a big influence. Were you an entrepreneurial kid? Your dad wasn't necessarily an entrepreneur, maybe not necessarily your mum. Did you think you were an enterprising kid? Were you go-getting the lemonade stand, if you would, or?
Yeah, I don't think so. I didn't go through, creating a widget and trying to sell it to my mates at school. I never went through that. But I think I always had a mindset of doing something. I had to be busy and I had to do things. Part of that was more about how did I learn about business than how did I, than the entrepreneurial journey. And that also had a little bit of the reason why I think Adumo opportunity came my way. So I was always interested in business. As a young kid, maybe it would be regarded as, child labor these days. But, as a young kid, 8, 9-year-old, 10-year-old, helping on a weekend in my grandfather's shop, learning how to count, learning how to interact with customers, packing vegetables, and that just interaction and that introduction to business, I think sets people up for a big learning curve in those really early influential days. Moving to South Africa and then almost telling people I was 16 or 17. Meanwhile, I was 14, 15, and I was a small kid, so I'm not sure why they believed that I was 16 or over, so I could work in a store, selling men's clothing while I was still at school, working as a barman in my matric and in early years out of school. I think at one stage I had 3 jobs. So I always had this desire to be active, a desire to be part of business, the desire to earn. And I think kind of that set me up in terms of some learnings around, you're exposed in the early days to these different types of businesses. You learn to have an intuitive sense around economics, around, gross profits, around revenues and how they made and I think this set me up very nicely into a career.
I mean, of course, thank you for sharing that. I'm curious because there's obviously the entrepreneur muscle. We may not know it's the entrepreneur muscle being built, but also you've moved here, and you'd mentioned to us at our live event, thick Newcastle accent, moving into a predominantly Afrikaans country at the time, Afrikaans speaking country. This is the 80s, and probably stuck out like a sore thumb. That's probably why you passed at 16, I'm sure. Did that build a resilience in you as well, perhaps? I mean, what impact do you think that has on someone's upbringing when you are the different one? You want to fit in, but you stand out. Yeah.
Yeah, it's very interesting because I think the accent in particular, and if I'm sure a lot of your listeners have traveled and they've gone to the UK, and with Newcastle having a more prominent football team these days, that's the kind of area that I came from. And that Geordie accent, unless you are from the area, it's just difficult to understand. I remember taking my wife back. Well, she wasn't my wife at the time. And my uncle was chatting away to her. She turned to me and goes, "What is he saying?" And that's what it was like for me.
Yes.
In moving to South Africa, we went to a mining village in Kriel, which is in Mpumalanga. There was an English school and an Afrikaans school. Lots of conflict between the English and the Afrikaans. My accent was lost quite quickly. The first few days at school, the teacher looked at me and my brother and my sister like, "What are you saying?" And I think there's this desire we have is to fit in. And so in order to fit in, you kind of change and you morph, and you do that quite rapidly. And so losing that accent was probably one of the key things to be able to communicate in the way that people around you are communicating. However, the moment I turn around and speak to my parents, even today, an accent comes out.
Yes.
So it's never really lost. It's just you build these tools in order to fit into a situation.
Sure.
And, that tool set of being able to change an accent being one, maybe that's a foundation to have these ability and have this adaptability to fit into certain situations, which has helped me throughout my career, throughout my life.
I think why I'm always so fascinated about opening an episode on this basis is these things are never lost. This is the irony. We look and admire many founders today kind of in isolation, without the context of who they are. It's why we're so adamant to try and share a bit more about the story, right? And ironically, it's the story that listeners, that entrepreneurs and folks actually relate to and can empathize with. You matriculated in 1990. I hate to put you on the spot here and make you, again, wisdom, not old age. That's what we're gonna emphasize here. But you do so as a deputy head boy. You'd mentioned to me a pretty strong academic, enjoyed your sports, and you're also an avid horse rider. So much so that post matric, that's actually the thing you want to do. Maybe just tell us a little bit about that season, because it's maybe something some younger listeners might be navigating in terms of decisions and those sorts of things. I know it didn't last very long. You'll give us the context on that. But
I think super interesting, because I think I went to a government school, Kempton Park, a school called Norcombe High. I've still got quite close connections to that school. But unfortunately, I think what a lot of kids today don't have is access to good advice. And maybe that was part of my initial journey, was the advice that I had. Was it good advice? Was it well presented? If it was, did I listen? Maybe not. So I think all of those things you've got to take into consideration. I had very young parents. I mean, my parents, my dad at 19 had 2 kids. My mum was 18. They decided to wait a couple of years till they had their third. So very young parents, and I think they were still growing up while we were growing up. So It was quite interesting. And then, living in Kempton Park, we had role models from their friends, and because family's still in the UK. And again, I think I had access to some good role models in those times. Was the advice coming out of school the best? Maybe, maybe not. I think it's still a problem today. So I ended up following a passion. And I think today, or certainly a few years ago, people were saying, "Oh, follow your passion and do that." And I actually heard a clip recently. It's like, no, you've got to find out what your talent is, and then build a career around your talent, not necessarily following your passion, because the 1% of 1% succeed in following a passion, whether because talent, the innate ability to run the fastest. Maybe you love running, but certainly not going to build a career out of it unless you're the top 1% of 1%. So it really resounded with me around, this, find your talent and work on that and use that in building a career or building a business. I had a passion for horses. I still do. If we did this a couple of weeks ago, I would have come in with a sling. Recently dislocated a shoulder from a fall, so I'm still an avid horse rider, or maybe an avid faller these days, but still love that, and it's still a passion of mine. And I did leave school going into thinking this career in horses was what I wanted. I think I was fortunate 6 months into a diploma at Pretoria University, Pretoria Technikon. Part of it was the logistics. I had to get on a train every morning from Kempton Park to Pretoria and then get to the Technikon. It was a hack. It really was. And I really feel for people that have those logistics problems. But outside of that, I think it wasn't a career I wanted. I had this desire to have a business, to be in business, and the access to horses, and that was more of a passion. And I think part of it as well is you make that your business and you may kill your passion. So I think it is good many ways to split them, and kind of that's what I decided to do.
Interesting. I know you mentioned it was a hard conversation with your parents at the time because they were obviously, and maybe I don't know what advice you received, but they were pretty much all in, even if you had to convince them to do so, only to turn around and change your mind, which, by the way, is okay. I think when we're that young, right?
Yeah, I think that I had more of a problem with it than they did. I think the one thing I did get from my parents from the start through everything that I've done is full support. And I think that really helps a lot. It does feel like because of the commitment they making behind you, it feels like the turnaround becomes more difficult. And kind of that's what I felt. But once it was out in the open, it's like they fully supported what's next. With an advisory, right?
Of course.
I think the one thing though, the next part of my development, which was into computers and computer programming, was at my cost. So I had to go and get a bank loan for it. So although they're very supportive, that's fine, but
some consequences.
There's consequences of this, and I think it was a good learning curve.
You've alluded to what was next, though, and again, contextually, this is the early 90s, right? So getting a career as a software, there was no software engineering, right? It certainly wasn't termed that. I'm curious to know why, because even this is pre-Silicon Valley, this is pre-big listings, this is what was the inclination, or did you just say, man, this is probably going to be the future? That's why.
No, I was never that visionary in looking at this. It was very practical. And I think the one thing coming out of my exposure at Pretoria Technikon, one of the subjects was IT and computers. And I loved it. I had lots of fun doing it. Came quite easy for me relative to others. So as part of that, I thought, I want to go into the world of computers. So the world and coding was, at that time, very few schools did it. There were private institutions, but that's kind of where I saw myself and created a great foundation, actually, in terms of coding for the future. Although I never worked as a developer, as a coder, but it did create this incredible ability for logical thinking. And I think in any business, in any environment, to have a logical thinking, a problem-solving mentality, it's just a great foundation.
So much of what that season is about, right? It's actually just building that kind of mental framework. It's why engineers make great non-engineers, ironically, isn't it? Now, I certainly don't want to do a disservice to the first couple of years of your life, but you did a lot of things. And so we certainly don't have to itemize them, but I recall you finishing that diploma there weren't exactly many jobs available directing coding. You spent some time at a Japanese trading house in the import and export space. You end up traveling extensively for Mitsubishi Corp. There's a whole bunch of others, right? Is there anything you specifically want to reference to that season? Was it more just about finding where you fit?
Yeah, it was a bit of finding your groove and kind of where you fit in. But I think there was a thread between all of those. I think one is I often worked in very diverse companies, the Japanese trading house in particular, with lots of exposure to international businesses. It's a very young man. And the ability to operate in that diverse environment, I think, is a must for kids getting into the workforce. The other was often around business development roles. So I was looking at how do we grow revenues. I think set me up beautifully for my early founding of SureSwipe at the time. So it was a bit of jumping around. It was a little trying to find my groove, but there was some threads, some golden threads through kind of all those. When I say all those roles, there was maybe 3 or 4 in that period.
You were living in Cape Town at the time, correct? You'd moved to Cape Town by this point, is that right?
No, Johannesburg based, but
okay.
I did spend 2 years in Cape Town over the millennium, which was probably the best time ever to be in Cape Town.
Yes, sure. Other roles included trading steel. You moved to Afrox at a point, more the healthcare space, probably your first step into healthcare, which does have pretty impactful leaning into what you end up doing for a couple of years. We'll talk about that now. And I know you ended up in a medical distribution business, chronic medication via mail order, because that's how it was done, right?
Yeah, and that was within Afrox Healthcare. It was one of their businesses. Set me up there, and that was kind of, as you say, the first entrance into healthcare, which was the stepping stone into where I am today. And yeah, I think that's super interesting business. That it was mail order, chronic medication distribution, probably the late 90s. Kind of early 2000s, and how that was in a business that fascinatingly changed with digital channels that opened up. So it was a real business that moved from mail order to kind of online distribution. So fascinating story in its own right.
Ironically, probably not fully solved yet, that space, despite it being a couple of decades ago, right? Now, I think what's formative, and I want to spend just a little bit of time here on this, is that a colleague of yours had moved to Jozi. They joined a company called HealthBridge, which is still around today. For those in the health tech space, broadly even maybe the fintech space, would know HealthBridge. It's a well-established scale-up in our ecosystem. They moved to this business in 1999, and they convinced you to join as well. And this is in 2000. If I'm getting my dates right, yes. And if I can caveat all of that, HealthBridge is fundamentally, they were funded to build out a system to really communicate between your healthcare providers and your respective insurers. Is that right?
Yeah, I started talking to them. I think the first introduction was the end of 2000.
Okay.
I joined them April Fool's 2001, to be specific.
Sure.
And they were part of the .com, which at the beginning, and also went through the .com bust. So there was some challenges in the early days there that they've pulled through, and a great business. I learned a lot there. I still have close ties to many of the founders there and the leaders. And
what did you, if I can ask, what did you join as? You'd done a couple of roles prior, varied industries.
I was living in Cape Town at the time, and they convinced me to. I was excited about the opportunity. It was a technology business. So the first time I'm going to a real technology first business, which was very exciting. I liked the people there, and they said, sorry, the role in Cape Town's been filled, but we've got one in Johannesburg for you. Do you want to come back? So I packed up and moved back to Johannesburg as I said, in March 2001 to start a role there. And they moved transactions between doctors and medical insurers, which at the time the bulk was still paper. Some of it was batch processing, and they built a real-time processing platform between doctors and medical insurers and went to market with that.
And this is still the early years of the medical aid industry. It certainly was. It was booming, but
Yeah, the medical aid industry had been around for a while. I think there was early days of the consolidation of that industry.
Excuse me.
So there was lots of medical insurers at the time. I joined there as a key account manager, kind of business development. And that's, again, some of the threads around looking at the revenue lines, customer-centric kind of roles that I had. And yeah, it was a great business to join. They had a booming probably a year, and then there was tough decisions that got made with the .com bust, which impacted that business as well.
I don't know how much of that you can go into, which is entirely at your discretion, but I know that you do spend a couple of years with Healthbridge, and eventually it's almost an intrapreneurship scenario where you get an opportunity to take the reins of a venture, working alongside some incredible folks there and trying to solve for a new challenge that they had, which becomes SureSwipe and kind of sets you on this different rocket ship, right? So maybe give us the foundation of all of that journey.
Yeah, so I think I always say I'm very fortunate, very lucky in terms of a career to end up where I am today. And part of that is when opportunities come along, I think you have this, maybe the sixth sense about what is the right opportunity and what's the wrong one. But I think what you have to have is be open to opportunities. And I think that's been part of my nature of being who I am. And I got set up quite well within Healthbridge from a project that I led. They give me credit for it, but I think I was part of a broader team that first of all came up with the idea that drove it out to market. But with lots of technology companies, and this was a learning, was they often purists. And Healthbridge engineers, exceptionally bright team, technology first, but purists. And they were going to market around their real-time processing was the only product or was the only service that they wanted to provide to the doctors. Now, great from a purist point of view, great from a technology. The reality is when you're waiting for adoption, sometimes you have to compromise. And that's what I convinced them to do. That's the credit they give me is around, I'm going to say, creating an idea or putting an idea out there that compromised this purist thought, but literally within a month, double turnover. And the idea was, at the time we were processing maybe 20, 30% of doctors' claims. The balance went on either paper or it went through batch processing. And my idea was, guys, let's just take it all. We'll take all of their claims. We'll, instead of the doctor working out which is the best method or best channel, we'll work that out for them. We get 100% of their claim volume, double the turnover in a month. Of course, it took a long time to build out the product and the logistics and operation, but it fundamentally changed that business. But it was a big learning. And again, around this, don't always be a purist. Look for other opportunities.
I trust the audiences are missing that, because that is proper wisdom and learned wisdom, I think, which we appreciate. I know you are a huge advocate for mentors and for having these people come in and maybe just give you some career guide. It's not even explicitly career guidance. I'm using the wrong term, but it's just these people that maybe been there, done that, and kind of willing to give you these moments, even if it's just a few moments of time to help shape that. You've had a couple of key people, even in that season, I think, come alongside you, despite being a young man and figuring it out, and being in the tech space is still quite early, comparably at the time. What was that more? Did that just happen incidentally? Was it proactive on your side to go out and look for these people? How would you typically speak to?
I think a little incidental. Although we did try and create, or the Healthbridge team did try and create this mentorship environment. Saying that, I mean, most of the leadership team there, a couple of years older than me. So it wasn't these old wise men that had been around and done it before. I think what maybe what they had, what I hadn't experienced, was exposure to a wide range of business leaders, entrepreneurs. And I think working within that HealthBridge team, the leadership team themselves, Harry, Ellie, Louis in particular, provided a lot of guidance, a lot of mentorship. They backed me on ideas, on I'm going to say proposals that were put in front of them. And then I got, as being part of that environment, had access to others. So it's a little by, it wasn't a carefully executed plan. It was a little bit incidental.
Sure.
But again, these opportunities are often put in front of people, and knowing when to take them is, for me, that's the big part. We often, even some friends, and look back on life, and you think, why did you make that decision? Look at the options you had and the opportunities that were put in front of you, and there's like, why did you make that decision? And obviously that's something from what they learned, the environment they've been in. So there's a little bit of that, and again, maybe a little bit intuition that is built over time, and having that intuition around taking those opportunities. I think, fortunate for me, was the right opportunities.
Yes, of course. You joined HealthBridge when? Remind me, please.
2001.
2001. You spin out SureSwipe when?
2008.
2008. Obviously, an interesting time in the world. 2008.
Yeah.
So
great time to start a business.
I was going to say, especially in the tech or payments space, not exactly easy. But 2008, something else pretty important happens, and you actually pitch the Exco, spin out SureSwipe as its own venture. And I'd love to maybe understand some context on that. Was it the purist versus other focus conflict, or what were you thinking there?
No, a little bit more simple than that. I think, as I was part of the management company, management team, management committee within HealthBridge at the time. I think there was 8 or 10 of us, as part of a regular cycle around looking at, what are the growth opportunities that we see within the business, the broader market. I think there was a timing element of, SureSwipe at the time had been introduced into the doctors market because the environment was changing. Doctors, when in the early days you had medical aid, they pay for everything. And then as they started introducing co-payments or savings accounts, the doctors had to start accepting cash or other payment methods on treatment. So there was a good timing of that. We approached Capitec Bank, who were our initial sponsor for in-store payments. We rolled that out to a couple of hundred doctors.
Are these, if I can just interject, are these fundamentally POS devices?
POS devices, card machines, terminals.
Card machines fundamentally,
Yeah.
Okay. But this is still, this is super early moving.
Yeah.
Think about the number of POS companies in the last 10 years that have popped up. SureSwipe is a really early, despite it being quite focused sector-wise.
Yeah, I think we were the first non-bank. I think to become a independent sales organization, payment facilitator, payment service provider. There's lots of phrases for that. But we had this in the doctors market, and I pitched it saying, guys, why only the doctor market? There's thousands, hundreds of thousands of SMEs out there that they've got similar problems, can't access. If they do access it, it's super expensive, and the service around that is pathetic. So just the idea of not limiting ourselves to a medical market was the idea that came out. Maybe it's, it's that not being a purist mentality around not just focusing on one market. But I pitched that to the management team, pitched it to the board, and, SureSwipe was founded.
I'm curious to know, because obviously the HealthBridge business, they own a lot of this, of SureSwipe, I'm sure, both IP and otherwise. You spin out the venture. Do you need to raise some capital now for this new endeavor? Is it a separate company? Is it clean? Is it, and it might be a bit technical. You don't have to go into a lot of it, but just a lot of founders, I think, especially the entrepreneur founders who see a similar opportunity. It's ironic how many times this, I think, is presented to people, and they rather stay the course because it's perceived to be way too hard otherwise. Curious to know about your experience in doing
Yeah,
that.
so I mean, in essence, it was spun out and operated independently.
Okay.
That's the construct. Now, how that was done from an entity point of view, that it changed over time. But the idea was this would run and operate independently of HealthBridge. HealthBridge would be a shareholder. I got some sweat equity and some into the business. And that's kind of how it started. We went with a very different model to many startups these days, which is go out, raise as much as you can, and then build something very quickly. We went a little bit slower. I think we had the luxury of doing that because one of the first to market. My mindset at the time was as little funding as possible. We want to be independent, which meant even from the business shareholders, HealthBridge, we had nominal amount in. I think in year one we turned a profit, and it's unheard of. And I think the reason for that was we went in with a very different mindset. So we looked at how do we create a business that is purely run on variable cost. So that means for every R1 we make, we give something away. But if we don't make R1, it costs us 0. So that was kind of as much as possible, we built a variable cost model. Yes, we had some people there, which were primarily sales and business development people. And even the broader team were commission-based. So it was very much a variable cost model. And then as the business grew over time, we insourced some of the functions and capabilities to where we are today eventually as we run and operate everything independently. But this starting a business around a variable cost model reduces risk, and it removes the need for giving away equity by bringing in external parties that are going to fund it. So it's not used as often these days because we've got this desire where raising money is more important sometimes, and to have that headline of how much you've raised versus how well are you going to use it. And to raise money like that, you give away equity, and that is the most expensive way to raise money. It should be the last resort. And what we're seeing today with a lot of founders, a lot of startups, is it becomes a bit of an ego around how much I've raised. The less you raise, the better, in my view.
I think, and we'll get into this discussion now, given that Adumo's had some pretty big news over the last 24 months. But ironically, raising money also comes at the detriment of valuation. And so you often ask yourself when you see these big numbers, and it's a super sexy headline in the moment, but then you go, well, how in the world are you going to exit this business and actually make some money for yourself and shareholders, right, in the construct of this market? So maybe I see you smiling. Maybe that's a convo we have offline, perhaps. But it's things that that founders don't think through, I think. And so that's great perspective from your side too.
Yeah, and I think
start with the basics.
And I think it it really went out of control in kind of 21, 22, particularly in fintech. I think fintech valuations were off the charts. People were throwing money at businesses. Founders took on a lot of cash. And often it comes with, and I don't know the constructs of different businesses, but I do know that private equity investors often put some conditions around that funding, whether it's preferential shares, whether there's some growth targets that come in that are not hit, and you end up losing a lot as a founder. So you've got to be very careful around bringing in money, first of all. And then the second part is, a bigger value is not always the best because it does come with some restrictions into the future. And those businesses that raised a lot of cash in 21, 22, needing money now, probably come at a down round, and it's the founders, it's the entrepreneur that's losing out there.
We trust you're enjoying today's episode, produced in partnership with our friends at Guard Risk Launchpad. We're now going to take a quick break and hear from Xolani Nhanga before getting back to today's conversation.
Hi guys, my name is Tolani Nglanga. I'm the Managing Executive at GuardRisk. I'm the founder of Launchpad. GuardRisk, if you don't know, is the largest cell captive insurer in the South African industry. We're part of the Momentum Group, listed life insurer in this market. Essentially what we do, we help to facilitate people getting into the insurance industry using our license. I think for simplicity's sake, you could call us rent a license, which I think is fantastic for any entrepreneur that wants to enter this very complex industry of ours, full of regulations. It dawned on us that unless we continue to add value to our clients, we'll become irrelevant. And so that's how Launchpad was actually born, was to say, how can we add value to our clients? How can we go beyond just giving them a license? So something like an innovation lab, for example, it's something that cropped up and we said, maybe we can create an innovation lab and we can come up with all these ideas. However, what we don't have is the luxury of time. And so we decided that we would go out and actually find entrepreneurs that we can work with. And to us, that made sense, in that we would then partner with people that are passionate about their ideas, they're passionate about adding value in the insurance value chain. And then, we would bring other things. We would bring funding, we would bring our complex insurance funding structures, we would bring our social capital, which is the networks that we have, be it reinsurers, be it our relationships with our regulators. And so we thought that's probably the best way to go about it. And then in addition, we said we also need to find a way to make this as less painful as possible. And so we created a Launchpad team that would be dedicated to the insurtech ventures that we would be investing in. And that team is there, and we have been talking to VCs, we've been talking to entrepreneurs. So we've also created a structure that actually facilitates these conversations, whether it be VCs or entrepreneurs. We made a decision that Launchpad will focus on early growth businesses. I think that helped us to refine our value proposition in terms of what we can and what we can't do. What we didn't want to do is really put out promises that we can't fulfill. So Launchpad is essentially for businesses that have got a proven MVP, they have got a viable market that they are servicing, the venture is generating revenue. It may not necessarily be profitable, but the venture is looking to scale up, and that's what we bring to the table. With almost 300 cell clients who operate in different industries, we think that is crucial for any venture that is looking to grow and scale up. That's what we bring to the table, and that's the person that we would like to work with. What we do know is very challenging with the insurance industry is the regulatory environment. We think that's very difficult, especially for someone that comes outside of the industry. Secondly, insurance is all about numbers. You need scale in order to really become a profitable business. That we know, if you don't have the networks, it's going to be pretty hard for you to do that. You're also dealing with businesses that have got legacy systems. That on its own, poses its own challenges, because when you start talking about, APIs and connecting, new technologies, you need a partner that's actually going to understand that. You may have designed your prototype on Google, for example, but then it has to comply with a large organization protocols. But to do that, you need someone who's actually prepared to walk that journey with you. Funding. Now, insurance is a long-term play, and you need someone that can be there with you that can provide you with different ways of funding your business. Because we're not talking here about overnight success. We're talking 5 to 10 years for a business to become really successful. And this is why Launchpad makes a lot of sense if you've got a great idea, which you need a partner who's going to be there with you for the long haul. And we think that if you're an entrepreneur with that kind of an idea, you better talk to us. So Matt, I think what has been very clear to us is that innovation in the insurance space needs to be supported by the likes of ourselves. What's also very evident is that the VCs also want to play in the space. But what is lacking is the domain expertise, which is what we bring to the table. So we are very, very open to working with other investors. We're very comfortable sitting at a cap table with other VCs, with other corporates who think the way that we do, or who have got the same interests as us. We would like to get in touch. We think that we've got something different to offer. I think we've got something special to offer when it comes to growing ventures that are in the insurance space. I think where there are problems, there's opportunities to find ways to solve those problems. First of all, the insurance industry is not known for innovation. That on its own for me is quite exciting, because it means that there's opportunities to impact how we engage with customers. There's opportunities to re-look at some of our products which had become dinosaurs. There's opportunities to look at the way that we deliver services, whether be it a claim on a device, be it a motor claim, be it a property claim. And the exciting piece is that it's so much easier now to come up with the technology that can solve these problems. There are a lot of ventures out there who are working tirelessly to solve the problems. And that to me is quite exciting. So the partnership with Startup Club to us was actually a no-brainer. We had Launchpad. We needed to get Launchpad out in the market. We needed to tell people about Launchpad. But not only did we have to tell people about Launchpad, we needed to partner with like-minded people. We needed to get involved in the communities that are day in and out thinking about these solutions. We needed to be in touch with other investors who are grappling with the same issues of how does one innovate in the insurance space. So Startup Club to us was really a no-brainer to get involved with people that are thinking exactly what we are thinking about. So if you want to get in touch with us, visit us on grlaunchpad.com. It's been great chatting to you, Matt, and we're looking forward to meeting like-minded entrepreneurs and investors.
That was Xolani Nhanga, Managing Executive of Guardrisk Launchpad. Thanks for listening, and now back to today's episode. Yeah, good perspective, and we'll maybe get into some more deal specifics, given that you're on the back end of some deal specifics. I think, and again, the great disservice here is we've only got limited time to talk through a few years of learnings, but the 2008 to 2010 period, you've spun out SureSwipe. The opportunity is massive, like you've mentioned. Obviously, there's an interesting calamity in that in some respect you're reliant on the banks, and yet they can be your biggest competitor in the space as well. So we can maybe talk about that in just a second. But I think you also saw a number of other new market entrants come into the space as well. I'm quite curious, given that you had this first mover advantage, you'd mentioned to me you're profitable from year one. It seems like you're running the business smart and well. Do you think there's anything you could have done better or more effectively to capture market share in the space. And ironically, we still see payments companies entering the space. The opportunity is absolutely not captured. We know that. But maybe earlier on, is there something you would have done differently strategically with the SureSwipe business? Had you had the opportunity? Given that we've spoken about that many times now.
I think it's the LinkedIn founder that says,
Reid Hoffman, yeah.
First mover advantage. It's not necessarily a success. It's the first business to scale. And if I look back, and the one regret that I have is we could have scaled quicker. We could have scaled larger in those early years because we were the first mover. And partly that is coming out of a business mindset where 100, 150, 300% growth, which is what we had in those early years, looked incredible. But looking back, it could have been more. Whether that would have gotten me to a different place than where I am today doesn't really matter. I think, I look back and say, no regrets, but a learning is we could have been more aggressive in scaling in those early years, definitely. The opportunity was there with less competition, and we allowed it in many ways the competition to catch up a little bit.
Okay. I want to get into, I think you'd mentioned to me very quickly, and maybe this is also about the foundations on which you're building. I've alluded to it. Capitec, your initial banking partner, not your only banking partner. What was the thinking around the various partners you bring on? Because you are, in some respects, infringing on their space, right? How did you navigate that?
Yeah, I think the banking infrastructure and the banking regulatory framework that we have hasn't been our friend. And I say that because we were always dependent on a bank to be able to operate. Capitec in those early days, they were looking for distribution partners to build their business. We helped them with that. And then they kind of changed their strategy, which meant we had to go out and look for another banking partner. We ended up at Mercantile. He was then bought by Capitec, so we were back to square one. And then we partnered with Nedbank, who's our primary partner now. And we've been with them for 6 years or so, 5 years. But it is a little bit, market dynamics have not been good to us and regulatory dynamics, because every time we've had to find a banking partner, move onto a new platform, the operational impact has been immense. And I think every time we've moved, we've lost 12 to 18 months of growth opportunities. So you do that, we've had to do 3 banking partners. So that's kind of maybe 3 or 4 years of growth opportunities in the 16 years we've been in business that we've missed out on. And that is still to this day, I think it is changing. We still have a high dependency on Nedbank. They've been a good partner to us in many ways, but we still compete with them in the market. So our access to our product, access to our business is through one of our biggest competitors. Just doesn't make sense from a market dynamics point of view, and it has to change.
Sure.
Otherwise, we're still going to be in this environment where protectionism of the big banks is there. Yes, it's diluted, but it's still there. So that has to change before we have real financial inclusion, or the ability to really drive out financial inclusion.
And it's, just such good wisdom more than anything else, because I don't think founders know what they're in for. This will be a space that is continues to just be the darling, if you would, of the African tech space. But these are some of the pills you have to swallow, if you would, to be able to enter. And so good. Thank you for sharing that. I wanted to speak to you very briefly about, and we're gonna park the business stuff for a second and maybe just talk the personal stuff, because it's just never spoken about, right? In and amongst all of this, we are balancing relationships, marriages, parenthoods, and all of these things. I'm a very public advocate of, I would never be able to do what I'm currently doing, or have undergone the entrepreneurial jump without my lovely wife. You got married in 2011, if I'm correct, 2011, 2012.
I think New Year's Eve, 2011.
Amazing.
Yeah.
And you've got 2 kids now. I think a quick anecdote away from the business stuff, but you've been running SureSwipe for 3 going on 4 years at the time. Well, it's a hard question to ask, but how would you comment around family balance? How would you comment around, there may be even a perception now that, gosh, that could just be a distraction if I want to win in the venture. I don't agree with that, but maybe just your comments on the balance side of things.
Yeah, it's interesting. I think it's how you set up the company and the company culture from the start.
Sure.
And I think from the early days, I mean, when we first started SureSwipe, the first thing we did in that first week is we a small team, but we looked at what's the value system we want to run by, what's the culture we're trying to build, what's the vision for the company. And I think that set the foundation for a lot of these decisions that have to be made. And we did want a business to build a business where people were able to have a balanced life. Now, I use that word balance very glibly because what I think is balance is very different. It's a very subjective view. And we do go through different phases in our life where it's all in at work, or you can get an opportunity to spend more time at home with your wife and with your children. I think I've been very lucky to have a very supportive wife. We, of course, like anything, when I pick up my phone at the breakfast table to see what's to start the day at work, it gets a very stern look from my wife and my kids. No phones at the table, and that's okay.
Yeah.
But I think you do need the support. You do need to have the conversations, and I think that's important. The conversation around, and I'm not the best communicator at home, so I'm not saying that it's all easy, but I think just having the conversation around what's important for you as an entrepreneur now, and what support you need, and when you can then spend more time with the family, and you go through ebbs and flows there. And I think I think that's important. I couldn't have done this without my family. I think, if I would have been, as a distraction and maybe could have been more in, probably would have had a heart attack by now, because I think that's what you do, right? You're all in, and you need that break. You need that balance. And sometimes family force you to do it, which doesn't sound great, the word force, but I think it's
the necessary
it's important.
Type of force.
I think it's, and that's it. I think it is necessary. So for me, it's been maybe a savior, having that distraction, having that ability to pull out of the business and spending time with family. We spend a lot of time together. So for me, it's important. But from a business point of view, you do get into the habit, or you can get into the habit where there's almost this, you get a star for working through the night, or you get a star for working 12, 14 hours a day. I think that's the wrong thing to award. You've got to reward people for delivery, definitely, but you can't reward people for spending the night at work. They have to get a break. They have to have balance. And whether that's a family, whether it's a sport, whether it's a distraction, it's super important to have that, more so these days, because on a weekend when you're on holiday, you're still checking your phone.
Sure.
You're
what you're
always
coming back to.
on.
Yeah.
You're always on. And what we're starting to see today in the work environment is burnout. We're starting to see depression that's coming in, and much, much more than what my early career. So I think having that balanced life has to become a company requirement, where that gets rewarded, and not the working 16 hours a day.
Yeah. If anyone wants a great job, go and work at Adumo. They've got the company culture and the values right, by the sounds of things. Quick plug for the recruitment team. No, thank you for sharing that. I mean, jokes aside, it's just not something we talk about, right, in this hard go-getting industry at all costs. Now, this is where I do a great disservice by jumping over a few years of your life, but I know the business at the time is growing, albeit, as you've mentioned, could probably be growing more aggressively. I know you're a fan of constantly learning, environmental or academic. Did your MBA 2013 to 2015. And I'm sure that, again, reframes a whole bunch around how you think about organization and leadership and structure, and maybe reprioritizes some things. 2017, a big year in the life of, in your life, a big year in the life of SureSwipe, and what is now become Adumo. Maybe give us some context on and what happened?
Yeah, I think 2017 we got to a stage, or I got to a stage where our shareholders at the time, still being Healthbridge or TradeBridge, as they branded the investment house, we had different views on the business, and not drastic, but I was looking at, this is the business that we should be investing in, we should be putting capital in, we should be growing the opportunities there. They had a different view around extracting some of the dividends, investing in other potential opportunities, including the Healthbridge business, which was fine. I think you go through those, businesses that are the same shareholder for life. It's very unusual. So we went through that phase, and part of that was my suggestion or my proposal to the shareholders at the time was time for new shareholders. And we went out and went through a highly competitive process to get the best deal, which I have had a responsibility to my shareholders at the time. And I think...
Did they receive that well, by the way, that prompt, or is that a more difficult conversation?
No, it wasn't difficult at all. It was probably in everyone's mind, kind of acknowledge that. So I think it's always difficult to raise it.
Of course.
But I think we have a responsibility to the business. I think they, as shareholders, as directors, they have a responsibility to, maximizing the opportunity for that business. So we were very aligned on that idea.
Yeah.
So we went through a competitive exit process, ran for quite a while, and I think in the end, and we had two competitive bids in. One of them was a company called Wirecard, which if anyone's in fintech, they'll know the Wirecard story out of Germany. And the other was Apis and CrossFin. And we could go in a segue to my Wirecard interactions and my Wirecard experience, but I think we dodged a bullet by not choosing them as the investment partner. And ultimately, at the end of it, they were quite similar offers, and it was that the Healthbridge, the TradeBridge shareholders were gracious and gave me, it's like, Paul, what do you want to do? So I got to kind of the final decision on that, and Apis and CrossFin were much more aligned to who we are, what our vision was, what the opportunity was. So we dodged a bullet with Wirecard and picked up what I think were two very, very good investors.
For any of our less experienced listeners, you're welcome to go and Google Wirecard, and you'll understand why Paul dodged a bullet on that front. But I think it does speak to also that intuition, that you build over time, and also just recognizing fit. And I know there were a number of other red flags, but folks can take that up with you privately, perhaps. I know, so you closed this deal, Apis CrossFin deal, 2017. If I'm correct, it eventually, excuse me, sorry, you proposed it. It takes until 2019, correct? Until 2019 to actually close this deal. So it's quite a long period, if I'm right.
It's a long process.
Yeah.
I think it was first positioned in 2017.
Okay.
We kind of closed it out back end of 2019, kind of third quarter.
Sure. And this is, just talk us through maybe the goal here, because this is actually where Adumo comes to light for the first time. The business is still SureSwipe up until this point, up until the 2017 point, yes?
Yeah, so up until 2017, still operating under SureSwipe.
Cool.
That's the brand, the operating entity. As part of I'm going to say, an exit process for the TradeBridge shareholders, we had a strategy, we had a plan that we pitched to the new investors. And that was why the Apis CrossFin consortium that got put together for me was by far the best choice for us.
Sure.
On the one side, we got access to Apis, London private equity firm, lots of investment in emerging markets, South Africa specifically, and CrossFin, capital I at the time, but CrossFin had assets in the payments, in fintech world, in payments. And I guess it was the start of a consolidation of the payments market that we pitched together, that we pitched to them, that they were fully aligned to. So that's when Adumo was founded, on the back of as an investment company with multiple payment companies under their portfolio.
And I mean, at the time, not so much now. eKorka was one such business. Folks may know the POS device issuer and the payments company eKorka, and another being GARP, one of the OGs, as the young people would call it these days, the originals in the payment space. But an exciting prospect, creating this group of fintech payments businesses. So you can understand why the acquisition makes sense, but nonetheless takes time. It closes at the end of 2019, and then obviously the world just goes sideways in 2020. I'm curious, do you just knuckle down at home, or what was the season like for you during COVID and during, you just fresh off acquisition? Maybe timing was good in that there was perhaps some cash at your disposal, but what would you say? What would you say about those tough 12 months in the world?
Yeah, I mean, I think for everyone it was very difficult times to navigate and manage a business. I think for me, putting this deal together literally at the back end of 2019, we moved into a new office in February 2020 and moved out 2 weeks later. So, and still trying to get to grips with what this future business, the structure, the people is going to look like was very, very difficult. And I think we kicked the can down the road a little bit, for use of a better term, around how we were going to structure the business. Maybe not a great outcome, but it was very difficult to build an organization, sure, to create a teamwork, to create a framework when no one was allowed in the office. Most of our business, or all of our business at the time, was in-store payments. So we had a very tough few months, maybe not as tough as many other people out there in their businesses. We were regarded as essential services. We were fortunate that a lot of our stores opened relatively quickly, but trading was down. Funds was down. We like most businesses, we had to manage our cash flows. We didn't have just investors that were just pumping money into the company. Sure. So we had to manage cash, manage our suppliers, manage our customers, manage our people. We went through an unfortunate reduction in staff. It was a minimum, but it was kind of the first time that we'd had staff reduction. I mean, certainly in my leadership. So it was a really tough time to go through. But we weren't alone out there. We weren't. I think for anyone, it was really, really tough times. And trying to lead a business through teams, it's not my style. And still to this day, I'm not a huge fan of digital meetings. So I try to get face-to-face time, and trying to change that was very difficult for me. I got a lot of grey hair during those few months. But we got through it, and I think we came out stronger at the end of it. The economy from a South African point of view is still limped along a little bit. So we haven't had the tailwinds of a growing economy. But as a business, we got through it. We pulled through. We had great shareholders. We had a good board that advised us, had a phenomenal team across Adumo. So we've come out strong at the other end.
Yeah, thanks for sharing that, Paul. And I think most founders will resonate with the season, albeit some have come out more scathed and others less. I'm curious because, 21 to 23, you kind of doubled down. I think there might have been some new cash you'd raised as well into the business, but very strategic. You'd mentioned to me there was a new focus on Adumo payments, trying to make a few investments as well. I think this is actually around about the time that I met you for the first time. I was not an investee, folks. There's no conflict of interest here. We just met in passing. And you also unbundle eKorka from the group and things like that. So there's some strategic, maybe macro things that are changing. But maybe condense this 2-year period for us, because up to 24, some big things start happening. And what was the context against which that happened?
Yeah, so from probably the end of 2020 to kind of early 21, we started, getting to grips with what this future business is going to look like. We looked at where the gaps in the business. We raised some funding from the IFC, about $15 million, I think, at the time. we used that primarily to actually do some acquisitions. So we did a lot in those couple of years. We rebranded to Adumo. We merged operations with the founding businesses. So we had, one contact center, one technology house, one brand, one team. That people management, that change management process.
I'm just thinking about how hard that is. Gosh.
And at the same time, we acquired an online business. Funny enough, the Wirecard South African business, we acquired them, so it gave us online capabilities, which we saw was a big gap in our offering. We also acquired a couple of startups. Not everything worked out, unfortunately, but I think we tried with some startups that would help us differentiate our product offering into the market. Maybe one of them was maybe too early, and there's a big learning in too early to the market. And we unfortunately went through that. The other large acquisition that we did, which was GARP Software. And the idea behind that was, what we're starting to see in the payments world is historically every payment interaction was the same. You'd go in, there's a card terminal, and you'd insert your card or you'd tap your card. And irrespective of the business type, that's how it worked. And what we started seeing is in certain verticals, there's going to be very different types of payment interactions or consumer interactions for payments. And we saw that in hospitality, and having access to that whole value chain was very exciting for us, and having a very focused approach to a specific vertical. We acquired GARP. They had quite a large market share at the time. They built out actually a new product, a new platform that they now rolling it out quite quickly. On the back of that, we've got some proprietary software that embeds payments into their platform. On the back of that, we've got unattended kiosks. We've got QR payments at the when you place your order. So there's lots of different touch points around the payment in that specific vertical, and that's the reason why we're very excited to acquire that business.
Amazing. Yeah, it's so funny because it's been arguably one of the problems that's been attacked with the most fervor by tech founders, if you would, across the continent. The payment space is arguably payments and remittance. And yet still so much opportunity to differentiate in these sector verticals and siloed, gaps in the market. It's very exciting. And I think it's on the back of that sort of excitement and maybe vision and direction. I'd love to ask you about this wonderful acquisition that's finally received approval recently. For those who do not know, Lusaka Technologies is a listed business, both domestically and abroad. They've actually initially shown some interest in acquiring Adumo, and that's just received approval from the Competition Commission, which is kind of the big rubber stamp for this to go ahead now. When we had initially met, that approval hadn't come through yet, so I know that there was still a question mark about the when and what happens. I'm curious, for most founders don't get to this point, and I don't know if that is good, bad, their fault, the nature of how the game goes, but just talk to us about how did that start? Is it you looking for an acquirer? Is it them reaching out? Is it a coffee that turns into a lunch that turns into how does it actually work practically for you as the founder?
Yeah, I think the first starting point is when the Apis CrossFin shareholders came in. Part of those discussions were an exit timeframe, an exit plan. So we were very much aligned from day one on when that exit timeframe would be. So I think it makes these conversations very much easier. This came through a little bit earlier than what the exit timeframe, the exit plan was. I think initially we were talking about going to market 2025 or 2024 with a sale. 2025 was the kind of the time frame we had in mind. We were approached and discussed outside of that with the Lusaka team, which I think they know us from a market. South Africa is quite small. They primarily operate here, so we signed some NDAs and went through a discovery process. So I think yes, outside of the initial time frame a little bit, but what we saw was the opportunity within, again, building a larger fintech, consolidating the market, into something that can be very sustainable, competitive in the South African market and beyond. Yes, payments is perhaps the darling of fintech, as you mentioned, because of the volume that comes through.
Sure.
But with volume and transactional, transactional revenues that get made, scale becomes very important. And we operate in a highly competitive market. The early days, as I mentioned, when we started, it was the banks, and the banks were not very good at servicing SMEs. You go online now, and there's multiple choices that you have with different business models, different devices, different ways to access the market. And with high competition comes pricing pressures. And when pricing pressures come in, market dynamics start talking about consolidation. And I think we saw that in our early days of founding Adumo was the first step in consolidation. And when Lusaka opportunity came round, just the scale that they have, the scale that we have together, it was maybe use the word no-brainer, but probably not the right term.
Sure.
But it was, it just made strategic sense, commercial sense for all parties. So it's great to get ComCom approval, which happened last week. We still some administrative actions to finalize, and we expect to close the transaction. We're hoping to close the transaction in the next couple of weeks. But very exciting, kind of not the end, but very exciting next chapter for Adumo.
Sure. Yeah, it's that's you've just anecdoted very small things, but like very few people have privy to access to even like a semblance of that process. I'm grateful for you just sharing that, and that's what founders, when they quote unquote are getting closer to the time, are in for. And so I think it's just great for you to disclose that. What does this mean for Paul? I'm curious. It's probably the question on everyone's mind, right? Is and you must get asked this loads. Does it mean, okay, cool, finally I can go and I go to passion. I mean, now it's pure passion. It doesn't matter about talent anymore, or with financial means do come options. Does it just allow the Adumo business to just thrive and look the next season? What are you thinking about as this is maturing now?
Yeah, it's a good question, and I'll get to it. But I'm going to take a little step back before to get this question, because I've been through, I guess, every part up until now of a business life cycle, from founding or starting a business through to listing, or through to merging into a listed entity. So it's been quite fascinating. And in between that, we've done fundraising, we've done M&A, we've consolidated our operations, we've closed some businesses. So I've been through a lot in this period of time. But the one thing that I've always been committed to and excited about is the business opportunity. And from a founding point of view of SureSwipe, in the days I had through a share scheme, I had some shares in TradeBridge. And right from the start, I was like, no, I want to convert those into shares in SureSwipe. When we exited when TradeBridge exited SureSwipe, I was very fortunate to be in a position where I'd just exited a business called Pandora Jewelry. I was an investor, and my business partner brought Pandora to South Africa, and we exited at the time, just before actually TradeBridge exited, and I was doubling down on my investment into SureSwipe and into Adumo at the time. Now that we've got this opportunity within Lusaka, this is not about an exit for me. This is about a reinvestment into Lusaka, because I believe that story is a great place to invest my wealth that I've created today. So I talk about my next chapter. It's with Lusaka as an investor.
Great.
In a listed entity. Yes, I think the listing does create optionality around liquidity that you don't have in a private company. So for me, that's very exciting. But I'm more excited about the growth opportunity that we're going to have together with Lasaka. So that's as an investor. That's kind of what I've done, and I'm very happy to share that story.
No, sure.
For me personally, they've got a phenomenal team there that going through a very arduous, detailed due diligence process. You get to know people. And from my early ideas of what this means was actually my early idea was I was happy to exit. But as I met the team, understood the vision, understood the opportunity within Lasaka, more and more I want to be part of this.
Amazing.
I really want to be part of building this future that we've started, and this next chapter for Adumo for sure, but also the next chapter for me. So I'm staying. I'm definitely staying with Lasaka.
Of course.
As part of this process. The structure that they've put together within that business has created an opportunity for me to take on a larger portfolio.
Amazing.
I'll sit on the executive team, reporting in as an executive team. We report into the chairman. Very different listed entity versus a private entity, but I think it does resonate with me, which is the one thing that I've always tried to do, and that is continuous improvement, continuous growth. And it's given me an opportunity to continue on my learning journey, on my growth path.
Mm-hmm. Yeah, I mean, thank you for sharing that, Paul. It's wisdom. I hope people have notebooks out, to be frank, because really, it's I don't say that to flatter you. It's just it's insights you don't get access to otherwise. So thank you for sharing that. I think it's a pity we run out of time relatively soon, but I'd be remiss not to ask you, or rather one, give you the opportunity to share. You see so many founders. I mean, you've even backed some founders personally as Adumo. You've made some investments. Some have worked, some have not worked. We've got founders across sectors, different seasons of their journey who will listen to this. What are some of the common things, perhaps, that you just see folks making the same mistake over and over again? Or it could just be questions mentees of yours or whatnot ask you regularly, and maybe some advice you would want to share with a national audience.
Yeah, so I think the one thing I see these days, which a little bit I get frustrated about, is around people starting a business to make an exit. Now, that doesn't mean to say you shouldn't plan for an exit and you shouldn't have that in mind, but it shouldn't be the reason why you start a business. So I think a lot of founders these days, access to wealth creation, quite a short-term view, and that's almost the end point. And I think what happens is you get so focused on creating an exit opportunity that you forget about building a great business. So I think that's definitely the one thing, and more we see that. And funny enough, I was actually at a breakfast this morning with some of, I guess, South Africa's pioneers, or certainly very impressive businessmen. And they were talking about generational businesses and generational wealth. And we don't see that anymore. No. People are looking at making a quick buck, getting in, getting out. And I just say, I've been at this 16 years now, and it's and continuing into the future. Build a business that people want to buy. Don't build a business that you want to sell. So I think that's the one bit of advice. The other one is that we touched on earlier. It's good to have external parties invest. Make sure they're going to add value beyond money, and only take the money that you need, not that you want. Because for every rand that you don't know what you're going to spend it on, you don't know how you're going to use it to grow your business, is a dilution of your equity. So be very cautious around the investors that you bring on. Be very cautious about the amount that you need, and rather bleed it in slower than take a big amount up front. So be very careful of that. And I think I was very fortunate. We had great investors in CrossFin and Apis, and I always say I'd invest with them again.
Sure.
So, and I think that's
that's a good reflection, isn't it?
That's really good to get those investors in. But often we get investors because they've got money and they're not going to provide any other value. stay away from those investors. Try and get both. I think for me, that's another bit of advice.
And if you can't get both, wait. Hey.
Yeah, I mean, waiting is often difficult because, you do run out of money. I think the third bit is if you get that money, don't spend it wisely. And what I've seen in the South African market, and maybe this is other markets, is, you see companies that are raising however $1 million. The next thing they're moving into the best offices, the smartest office park. The executive team are driving around with the fanciest cars. Not sure that's going to give a good view to your investors. So just spend your money wisely.
Sure.
And if you're going to be spending it on that, you probably didn't need that money up front.
Good wisdom. The last thing I'll ask you, and it's the question we ask everybody before they leave the show, is, and particularly interested in the context of you having seen many of the seasons and stages of the venture journey, is what does success look like to Paul Kent? Most folks are saying, well, and I think you've alluded to it already, because you could quite easily take cash off the table here and you'd rather choosing to double down, building for the long term. You've mentioned legacy businesses and things that family and generational wealth get involved in. What does success look like to you? Is it a tropical island when you're 80, or is it something more?
No, it's definitely not a tropical island. I don't have a great relationship with sand, so I try and stay away from the beaches.
Newcastle in you as well. Sure, okay, that's fair.
But no, I mean, I think the success. When I was younger, in probably my late 20s, I on the advice of actually a good friend of mine, I put together a list of things I want to accomplish in life. Some of it is family, some of it's business, some of it's personal, whether it's travel or learn to play an instrument or whatever it is. You kind of put these things down that you want in life. And you kind of, as you go through life, you can tick them off. And maybe that is a form of success. I think the other is maybe a little bit more philosophical around, is it really about happiness, contentment? I think that is a big part of it. And yes, it makes it easier when you've had some financial success. It makes it easier when you've built a company, going through an exit, and it takes away maybe a lot of the anxiety of, what am I going to eat at the end of the month? I mean, those are really hard times. But I think for me, that is more around success. I've got an extremely happy family, got a happy lifestyle. The one thing we would love as a family is to live on a farm. So I think, it's not the tropical island, but we'd love more of a nature lifestyle, maybe access to a farm. I think that's important. But it's quite interesting. My father-in-law, who built a business, and he's in his 80s now. And for him, one of the things that make him happiest is he looks at his kids and he sees his kids are settled with a family and are having a happy life. That's what makes him happy. So that's what he's measured success by. Sure. And it's quite a beautiful thing.
Beautiful. Yeah, beautiful. I get the sense it'll be similar for you. Paul, what a privilege. I'm conscious of time, and it's almost a shame we have to call this episode to an end. But I think I speak for most folks who will hear this. Yeah, what an opportunity just to hear from some of the learned wisdom. You've called it age, we've called it wisdom. But thank you. You've shared candidly. You've given us some insights to the founding side, the difficult sides, the technical sides, and I think listeners will be better for that. So thank you so much for joining us today.
No, it's absolute pleasure. Thank you very much.
Amazing. Ladies and gentlemen, that's Mr. Paul Kent, founder of Adumo. Thank you so much.
Thank you.
Thanks for listening to today's episode. That was Paul Kent, founder and CEO of Adumo. I'm Matthew Marsden, and if you enjoyed today's episode, please be sure to subscribe to our channel, follow us on our socials, and share this with your network. See you next time.